Thanks, everybody. And thank you, Rakesh, for the introduction, as well as the opportunity to speak to the Windsor-Essex Regional Chamber of Commerce. I'm very happy to be with all of you here today. Enbridge Gas provides reliable and affordable energy to almost 4 million customers, including 75% of Ontario households, and more than 20 Indigenous communities. And we've done that for the last 175 years. We're grateful to have a long-standing relationship with Windsor-Essex, and we're proud to be a partner in your wider community. We strive to make meaningful contributions to the communities that we serve, and that advance the work of organizations and initiatives that share our core values of safety, integrity, respect, and inclusion. This includes support to the Windsor-Essex County branch of the Canadian Mental Health Association, Essex County Field Naturalists Club, Windsor Fire and Rescue Services, and Hiatus House. As you know, currently the Windsor-Essex region is experiencing significant growth in a positive direction. However, as the population increases, so does demand for energy, which raises concerns about the environment. Keeping energy reliable and affordable is an absolute must for Ontario families and businesses. We can't focus on one over the other. By integrating energy systems, we can advance sustainability goals and achieve cost-effective reductions in greenhouse gas emissions. Today, electricity accounts for about 16% of the energy consumed in Ontario, and natural gas accounts for more than 30%, roughly twice that of electricity. Looking to solve decarbonization through electrification alone will have significant cost implications for consumers. Let me be clear. Addressing climate change by eliminating emissions is the right thing to do. However, if we're to succeed, energy providers, regulators, and all levels of government must work together to achieve emissions reduction targets without overbuilding, stranding assets, or compromising reliability, resiliency, and affordability. The pace of this transition is crucial. We must ensure that electricity grids can adapt and markets for hydrogen and carbon capture can grow. Failing to do so risks brownouts and leaves industries without practical alternatives. At Enbridge, our business is evolving to support our own operational net zero targets, as well as supporting the targets in the communities that we serve. This is our innovative energy diversity approach. You might wonder what innovative energy diversity means. Simply put, it's about fostering a comprehensive approach to achieving net zero energy emissions. This involves embracing clean energy solutions such as hydrogen, wind, solar renewables, compressed natural gas, geothermal hybrid heating, and renewable natural gas. Enbridge Gas is collaborating with stakeholders to explore and advance these clean energy solutions. We're proud to be at the forefront of pioneering projects in the energy sector. We have the infrastructure and the dedicated teams to bring about this meaningful change. And with that, it's my distinct pleasure to introduce another change maker, Toni Gravelle, Deputy Governor of the Bank of Canada. Toni Gravelle became Deputy Governor of the Bank of Canada in October 2019. In this role, he oversees the bank's financial systems, activities, and shares responsibility for setting monetary policy. Mr. Gravelle first joined the bank as an analyst in 1996 and went on to hold various positions within the Financial Markets Department, becoming Managing Director in 2015. In addition to his extensive research experience at the bank, Mr. Gravelle served as General Director of the Financial Sector Policy Branch at the Canadian Department of Finance from 2013 to 2015, and was an economist at the International Monetary Fund from 2002 to 2005. Mr. Gravelle is a native of Corbeil, Ontario, and holds a PhD in economics from Western University. Please join me in welcoming the Honourable Deputy Governor of Bank of Canada, Toni Gravelle.
You good? Oh, thanks. I'm just going to move the book. No, not here. How's that? Well, thanks, Andrea, for the warm welcome. Thanks for the Chamber for having me. And it's my first time in Windsor. I've been in the area before. I was in Essex and Leamington and Point Pelee, but it's my first time in Windsor proper. And then Rocco's comments are going to be echoed in my speech today. So I'm going to touch upon a little bit on housing, a little bit on immigration, and a little bit on monetary policy. So yesterday the bank, actually, I'm going to stand a little bit beside it. The bank announced it will maintain the policy rate at 5%. I will expand a bit on our discussions and thinking behind the decision. Then I will dive into recent shifts in Canada's population growth, focusing on how newcomers contribute to our economy. Immigration is one of Canada's greatest strengths. Our country is known as a welcoming place for newcomers, and Canadians are well regarded around the world as a place where newcomers are successful both in their communities and in workplaces. This is a reputation I feel we should all aim to keep, to protect. Why? Because newcomers strengthen Canada's labor force with their knowledge, skills, and hard work. They play a crucial role in supporting the economy's capacity to grow now and in the future. But there have been hiccups. Canada has structural housing supply challenges. This is not a new issue, and the recent increase in newcomers has coincided with a material housing supply issues. This raises questions about how chronic housing challenges might limit Canada's future growth and what the implications are for inflation. This will be the core focus of my speech today. First, let's turn to our decision. Yesterday, Governing Council held the policy rate at 5%. This reflected our view that our monetary policy actions are working to cool the economy and relieve price pressures. We have made good progress in restoring price stability, but we are not there yet. Let me explain what we are seeing. After a strong first quarter, economic growth stalled through the middle of this year. High interest rates are holding back consumer spending. Consumption growth was close to zero in the last 2 quarters. Business investment has been volatile in recent quarters, but remained flat overall over the last year. Housing activity rose 8.3% in the 3rd quarter. This was largely driven by new home construction, which increased for the first time since mid-2022. On the employment front, we are now seeing more signs that the labor market is easing. Job vacancies are nearing their pre-pandemic levels, and job creation has been lower than labor force growth. The unemployment rate has also edged up. However, wage growth remains between 4 and 5%. This is above the level consistent with inflation at 2%. Overall, the economy no longer looks to be in excess demand. So, what does this mean for inflation? The economic slowdown has helped reduce price pressures across a broad range of goods and services. Along with lower gasoline prices, this contributed to a decline in headline inflation to 3.1% in October. While food price inflation is still too high, it has come down. We are seeing price declines in durable goods like appliances and furniture, which are particularly sensitive to higher interest rates. However, shelter price inflation has picked up, a point I will come back to later. Our preferred measures of core inflation dipped slightly in October, and on a 3-month annualized basis, they have dropped to about 3%, which is the lowest we've seen in over 12 months. While we saw some welcome improvement in inflation measures in October, we must remember it's just 1 month. We will need to see further progress. The economy is now roughly in balance, but we are closely watching inflation expectations, wage growth, and corporate pricing behavior. These indicators are helping us to assess whether inflation is on a sustained path to 2%. Given the risk to the inflation outlook, we remain prepared to increase the policy rate further if needed. Comme je viens de dire, les données d'octobre sur l'inflation sont encourageantes. Mais un mois d'amélioration, ce n'est pas assez. Il faut que ça se poursuive. L'économie est maintenant presque à l'équilibre, mais on surveille attentivement les ententes inflationnistes, la croissance des salaires et les pratiques d'établissement de prix des entreprises. Ces indicateurs nous aident à évaluer si l'inflation garde le cap sur la cible de 2 %. Étant donné les risques entourant les perspectives d'inflation, on reste prêt à augmenter encore le taux directeur au besoin. Our decision to maintain the policy rate at 5% reflects our best efforts to balance the risk of over and under tightening. We don't want to slow the economy too much, but we also don't want to have Canadians to continue to live with the pain of high inflation. Now let's consider immigration and its effects on the Canadian economy. Canada has had the fastest growing population in the G7 every year since 2016. I probably don't have to tell you that newcomers are driving most of the population growth. Immigration is not a new story for Canada, but it has changed over the last few years. Annual targets for new permanent resident admissions have jumped up by about 50% since 2019. We are also admitting more non-permanent residents, a category that includes foreign workers, international students, and refugees. Work and study permits and asylum claims are around 40% higher relative to 2019. Canada welcomed more than 1 million newcomers over the past 4 quarters alone, 60% of whom were non-permanent residents. Now I want to explain a key benefit to welcoming newcomers and helping them put down roots. It boosts our potential growth rate. The potential growth rate is how much the economy can grow without causing inflation. It's kind of the speed at which we can grow without causing inflation. To explain how potential growth works, I'll use an analogy based on making tourtière, a French-Canadian meat pie that is part of my heritage. Chaque année, dans les temps des fêtes, mon frère prépare des tourtières pour en donner à la famille. Pensez à la croissance potentielle comme à la quantité de tourtières que mon frère peut cuisiner en une journée. S'il veut faire plaisir à plus de membres de la famille, il doit augmenter sa production. As I just said in French, my brother makes tourtières during the holidays to give gifts to family. Think about potential output as the number of tourtières my brother can make in a day. He can boost his tourtière output or increase potential growth in 3 ways. Through increases in capital. He could buy a second bigger stock pot to make more of the meat filling for the tourtière. Through productivity. He could rearrange part of his kitchen to make it more like a production line so he can put the tourtières together even faster. Or through greater labor supply, he could get his kids to help him out. We all know how hard that is, but he could try. So strong immigration since the start of 2022 has helped increase Canada's workforce, like having more people help make tourtières. This has boosted the level of our potential output by 2 to 3% without adding inflation. That's a big deal. This is a significant improvement, especially considering Canada's otherwise rapidly aging population. More than 1 in 5 working adults in Canada is nearing retirement, which acts to hold back workforce growth. When I just went through this, kids helping tourtière. Most advanced economies are facing a similar demographic drop-off as members of the baby boomer generation retire. But Canada is doing better than others thanks to immigration. Our working age population is growing faster than the United States, the Euro area, and the UK, and many other OECD countries. Notably, the pace of growth of Canada's working age population has more than doubled that of the United States over the last 4 quarters. When we look at the data on recent employment gains, we see newcomers are driving job growth. Recent newcomers have helped soften the tight labor market, easing critical labor shortages in many sectors. For example, job vacancies have dropped more than 65% from their peak in the financial and insurance sector, a sector that has seen a notable rise in newcomer workers. Overall, job vacancies have fallen more in sectors where the share of newcomers working is growing faster though the softer economy may now be also playing a role. However, missed opportunities remain. We all heard stories about foreign-trained doctors driving taxis or working at daycares because they face challenges getting their credentials recognized. And it's not just the medical field. Many newcomers are underemployed because their credentials are not recognized here. This means some specialized jobs that could have been filled by a skilled newcomer may instead remain vacant. That hurts the economy's potential growth. Now let's turn to how the arrival of newcomers affects inflation. As I just explained, higher immigration has improved Canada's supply of workers. That will greatly strengthen our economic prospects over the long run. But we are living in the present. And when newcomers first move to Canada, there is an initial burst of demand for goods and services as they set up a home. In aggregate, this could put pressure on inflation. We estimate the boost to aggregate consumption spending from the recent increase in newcomers had barely any effect on inflation, less than 0.1 percentage points. Of course, newcomers don't just consume goods and services, they also need a place to live, and this is where we do see pressure on inflation. When a country's population is growing quickly, the supply of housing also needs to increase to avoid a worsening in affordability. As immigration began ramping up in 2015, Canada's vacancy rate started to fall. Then, when newcomers' arrivals picked up sharply in 2022, this steady decline became a cliff. Canada's vacancy rate has now reached a historical low. Even before 2020, the construction of new housing was not keeping pace with population growth. This was because of structural challenges like zoning restrictions or lengthy permitting processes in many cities. This is the speed to decision point that Rocco made. A shortage of construction workers, just to name a few of the issues. Canada's low vacancy rate shows how imperative it is to address these challenges. The recent focus by all levels of government to increase housing construction is a welcome development. Shelter price inflation, the housing balance also has a consequence for shelter price inflation, which accounts for about 25% of total CPI. Shelter price inflation rose 6.1% in October and contributed 1.8 percentage points to the 3.1% we saw in October in total CPI. Higher mortgage interest costs are part of the reason shelter price inflation is high. When we raise interest rates, mortgage interest rate inflation typically goes up, and this was anticipated. But a decline in other components in shelter basket usually helps offset this rise. We have not seen the same degree of offset this time. If we look more closely at the data, we see rent inflation accelerated to a 40-year high in October. At the same time, components tied to housing prices have declined, but not as much as we had expected, given the high mortgage rates and the slowing economy. Most newcomers rent when they first arrive in Canada, which works to push demand for rental housing and can lead to a short-term pressures on rent inflation. Research shows this pressure dissipates relatively quickly in a flexible, well-supplied housing market. However, Canada's housing market is not well supplied due to the complex set of structural issues I have already noted. To get a better sense of what's happening with rents in Canada, let's do a quick international comparison. Living across the river from Detroit, you are all probably very familiar with just how different housing markets can be between Canada and the United States. In the US, rent inflation had risen meaningfully, but it has now peaked and is declining. In Canada, it continues to rise. So why are we seeing such different stories? The difference in population growth is likely one reason rent inflation looks so different across the border. But the bigger issue is that Canada's housing supply has not kept pace with recent increases in immigration. This looks to differ from the US, where multi-unit construction increased significantly to recently hit a record high. The US has traditionally taken a large share of immigrants who work in construction, contributing to home building. Indeed, while Canada is welcoming more newcomers than ever, only 3% of non-permanent residents work in construction. Canada also has an immigration pathway for qualified construction workers, the Federal Skilled Trades Program, but it accounts for just 0.1% of all permanent resident admissions. This worked out to be 455 newcomers in 2022 out of 1 million, over 1 million newcomers in 2022. Of 20% of Canada's construction workforce, and 20% of Canada's construction workforce is set to retire the next decade. A lot of them are baby boomers. The federal government recently launched a program to prioritize construction workers for permanent resident status, which is a positive but modest step. This leads me to the relationship between the construction of new housing and demographic demand. Demographic demand is driven by both new arrivals to Canada and new family formation from within existing Canadians. When we look at the 5 years leading up to the COVID-19 pandemic, the demographic demand for new housing grew somewhat faster than new construction. This undersupply of new housing before 2020 is another sign of the long-standing housing challenges I have mentioned earlier. Then, in the last year or so, demographic demand soared above the pace of new housing starts. Next graph. This jump in demographic demand, coupled with the pre-existing structural supply issues, explains in large part why rent inflation continues to climb in Canada. It also helps explain, in part, why housing prices have not fallen as much as we had expected. To sum up, the recent increase in immigration boosted consumption in the near term, but we estimate that that alone did not have a significant impact on inflation. However, due to Canada's existing housing supply challenges, population growth has played a role in adding to the pressure on shelter price inflation. Had builders been able to respond more flexibly to increased demand, it would have helped reduce upward pressure on rent and housing prices. Let me wrap all this up. I have said a lot today, but I want to make sure you leave understanding that newcomers are a positive thing for Canada. Newcomers have helped ease labor shortages and loosen tight labor markets. They have significantly improved our country's potential growth, which will help keep a lid on inflationary pressures in the long run. But Canada needs more homes. And we need to make our housing supply more responsive to increases in demand. This will allow us to properly welcome new arrivals and will ensure all Canadians have an affordable place to live. The housing supply issue is quite complex, and we need all levels of government to work on a variety of policies. We need to reduce the barriers to adding supply, and we need to ensure the market has a greater flexibility to meet future changes in housing demand. Without these changes, we could continue to see upward pressure on the components of inflation related to rent and house prices. Canada is known around the world as a country that embraces newcomers, and even when they arrive in large numbers. As I said at the start of my remarks, this is one of our country's greatest strengths. Solving our housing supply issues will make life easier for all Canadians, and it will allow us to fully realize the long-term economic benefits of our recent population growth. Comme je viens de dire en anglais, le Canada est connu dans le monde entier comme un pays qui accepte volontiers les nouveaux arrivants, même s'ils se présentent en grand nombre. Comme je l'ai dit au début, la facilité avec laquelle les Canadiennes et Canadiens accueillent les nouveaux arrivants et les aident à sentir chez eux est l'une des plus grandes forces de notre pays. La résolution des problèmes liés à notre manque de logement facilitera la vie des gens et nous permettra de profiter pleinement des avantages économiques à long terme de notre récente poussée démographique. Thank you and merci.
Is not, there we go. Ladies and gentlemen, we have a few microphones. If you would like to ask a question, we ask that you come up to one of the microphones for our guest speaker. Thank you.
Hi, this is Manjri Maheshwari from St. Clair College. I'm a data analytics professor, so I was just going to, you had a lot of data put in out there. So the problem of construction workers you mentioned, right, and then number of houses being built. So, and you also mentioned that immigration policy is there. There's a pathway for them to come in. So why the number is still so low? for them to like come here? Any reasons for that?
I won't have all the details, but it could very well be related to the structure of the program, the parameters related to the program. It could potentially also be related to the people who tend to move to Canada are not in the construction field. I'll give you an example. When I lived in the States, I lived in the States for 3 years, and you had house maintenance, or you added an addition to your house, or you walked by a construction site, the major language you heard was Spanish. A lot of Latin American immigrants are working in construction in the United States. In Canada, we just don't have that. So I don't have the full details, but my guess it's related to the way the program's structured, the way certain parameters are structured as well. I know a lot of, if you talk to developers, people who, the smaller ones especially, they always say there's a huge shortage of construction workers. So a lot of the programs, the permanent resident programs are geared on kind of a point system related to it a lot, and there's a lot of weight on education. But construction sometimes needs non-educated workers. They need more blue-collar workers. So maybe the program's not geared for that. But
So
I don't have exact answers.
No, I was just like, so it looks like there's some gap there then in terms of the policy and what they're looking for.
Yeah.
Okay,
Good.
thank you.
Bonjour, Monsieur Gravelle. Merci de venir à Windsor et j'espère que tu vas revenir à une journée plus proche. The question that I have, you made some really good points and interesting points about the impacts on the housing market for temporary newcomers into Canada, and particularly temporary newcomers. I'm wondering if you could comment also on whether or not the bank considers the impact for municipalities. I sit as a municipal councillor in the city of Windsor, on the range of services that the municipality has pressure now to deliver, thinking about transit and perhaps a range of other services, to accommodate that population growth, in that context of being potentially temporary, hopefully permanent in some cases, but that also is a significant economic factor that we're dealing with at the City of Windsor.
I can comment in a more general sense. I mean, one of the things I touched upon in my Tocha example is investment in capital. All kinds of investment improves the capacity for the country to grow. Municipalities also have to invest in a form of capital, which is typically public transit. So that is good for the sort of the economic potential of economic potential growth for Canada as well. So these are all good things. In terms of the challenges, again, it's I won't comment on fiscal policies. It's not our field. Our field is to look at the macroeconomic impacts of various activities and add it all up. And anything that improves potential output, including investment in capital, or in this case infrastructure, is a long-term positive for the economy. It increases the speed at which we can grow without causing inflation. It's a good thing. How do you get that in place is policies, usually fiscal policies, municipal government policy, and we're not here to talk about that.
Fair enough. I get, so if I could just make sure I understand what you're saying, from a macroeconomic perspective, investments in transit, regardless of what's driving it and regardless of how you get there, it's a good thing for Canada in general and the communities where they're served.
Yeah.
Thank you.
Well, thank you for coming.
There's a big lineup now.
Big lineup.
Two.
Two. As a municipal leader, and I guess the buzzword is housing, housing, housing. But there's a big piece to that, and Councillor McKenzie sort of alluded to the fact that there's a tremendous amount of pressure on municipal governments to help build those homes. But the key factor is about the infrastructure requirements to do that. And it's not just about a water line or sewer pipe that goes to a new property or new lots. It's all the other needs in the community that with an increased population, your cultural centers, your libraries, all of that is going to be sustaining growth and the maintaining of it. And one of the comments you made, and I totally agree, is that it's going to take the three orders of government to get together to get to deal with these challenges. But here's the problem, and I know you can't answer the fiscal piece, but part of it too is that one of the areas municipalities use capital to able to bring that infrastructure to bear to build those homes is development charges. And we all know some of the governments want to increase the supply of affordable housing. And then, but now we want to remove one of the only areas outside of property tax increases to raise the money to build the infrastructure to be able to sustain that. And that's kind of the vicious circle that we're dealing with at the local level. And it's not as if we're not wanting to build these homes, it's just the cost of doing it. And if you have any inside works with the Minister of Finance, one of the areas that I would say are very important is if they're not forthcoming with grant dollars to municipalities to be able to build the infrastructure required for us to build the quotas that they want us to build, the one thing that they could do is very low interest loans to the municipal sector so that we can accomplish what is required for us to deal with the incoming demand for housing and make sure that the infrastructure is there to be able to sustain that. And I think that's a key for us, is that development charges are an area where growth pays for growth, and it doesn't impact the property tax owner, which are already taxed fairly high. And so if you've got that in with the minister, please have that conversation about low interest loans to municipalities for us to build our infrastructure.
I can assure you she's not on my... Thanks. Good comments. There wasn't a question in there, so. I'm sure I'm not on her speed dial, sorry.
Hi, Tony. Thank you for that great presentation. My name is Noor. I'm from Build a Dream. I focus heavily on building the talent pipeline. I want to clarify a stat you said. 455 newcomers out of 1 million are in construction. Is that what you said? Those that are working within the construction industry.
That end up in the construction industry.
That end up in the construction industry. So I'm curious how you feel. I've always thought, and I'm not sure if this is something that you can even answer. So we have a lot of international students coming to Canada to study here. And I've always wondered if there was a policy that could be passed for those that do come to study here, let's just say, in a program that's not in demand in the labor market, if they could switch their international student visa to a working visa, because if they go into construction, they're technically working, but they're an apprentice. So they're working 90% of the time, as you know, and then 10% of the time they're in school. But I'm curious if there's ever been discussion around that, because I do feel when I look around, a lot of international students that come to Canada for a better life or for whatever reason are looking ultimately to find and gain long-term employment. And unfortunately, sometimes, not due to our post-secondary institutions, they're wonderful, they're just going into programs that are not in demand, or there's just enough people in the labor market. So I'm curious if that's ever been discussed, or if you can talk a little bit more about that.
So again, my speech was about providing this kind of big picture issues related to immigration, housing, and economic growth and inflation. The Bank of Canada does not do a lot of detailed policy analysis on immigration programs. That is an area for the government, the federal government, and some of the provincial governments as well. So those details we just take as given. The current programs, we don't try to provide advice on how to change those programs. It's not where our role is. Our role is monetary policy and financial stability.
Okay, thank you so much.
Okay, we've got time for one last question.
Thank you so much. Thank you so much for being here, Deputy Governor. I just have one question. Is the Bank of Canada worried that as the economy slows down and we lower the interest rate again, will that impact housing costs and they might go back to peak levels a couple years ago? And what impact would that have on inflationary pressures if that were to happen?
Can you read the first part?
So as the economy slows down and the Bank of Canada lowers the the interest rate, are you worried that the housing prices
Yes,
will go back
sorry.
to a couple years ago, and what pressures will that have on inflation?
Yeah. I mean, one of the things we do is we take into account the whole of the economy. So housing activity is one sector. We don't target one sector. We look at the whole of the economy. We use our policy rate to adjust or help steer the whole of the economy in order to bring inflation down. So we've raised the policy rate to help slow the economy down. That typically slows down house price increases. But as I discussed in my speech, we have a structural supply issue in housing. So when we had low interest rates, we had affordability issues. When we have high interest rates, we still have affordability issues. So the interest rates are not the one and only factor that drives house price movements. There's a whole variety of other issues that affect the house price issues, including the structural supply issues that I spoke about. So we're going to continue to try to lower inflation or get inflation down to our 2% target. And then again, my speech kind of spoke to the problems or the issues that might drive house prices more than interest rates are driving house prices.
Thank you.
Okay, thank you everyone. And now can I request Steve Salmons, the presidency of the Windsor Port Authority, to thank our keynote speaker.
So, good afternoon. My name is Amélie Ferron-Craig, press officer for the Bank of Canada, and I will be moderating this press conference. So, Deputy Governor Gravelle is pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone that my colleague will be passing around. We also have some journalists participating remotely today. So we'll do one round in the room first, and then we'll turn to the call and make sure everyone gets a chance to ask their question. And the Deputy Governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil et libre à vous de poser vos questions dans la langue officielle de votre choix. So we will start with Julie from the Windsor Star.
Good afternoon. Julie Coates is from the Windsor Star. You mentioned earlier that this was your first time in Windsor, and I'm wondering, can you tell us why you're in Windsor today?
I'm in Windsor today to have provide a speech to the Windsor-Essex Chamber of Commerce, but in particular, we at the Bank of Canada, our deputy governors and the governor, are keen to understand what's happening in various regions in Canada, to understand how the economy is growing in a particular region, what are the certain factors that are driving that growth, understand what's happening in terms of labor markets in that particular region, more on the ground, and get a better perspective on what Canadians are facing in particular. So today I had a speech, I met a lot of people at the Chamber of Commerce, and I also have another engagement tonight with some more people in the business committee.
Hey, Chris with CBC Windsor here. Sorry to interrupt there. We heard you talk today about housing supply. When we talk to builders, they point to inflation and interest rates as some things that prevent them from building. What are the messages that you want to send to the builders of these houses as you talk about supply rate, considering the rate continues to stay the same?
So there's a lot of factors that affect housing supply. As I mentioned in the speech, Canada has been in a chronic period of undersupply. Of course, interest rates play a role in the capacity for developers to finance some of the buildings, but we've had low interest rate periods where we've had undersupply. Now we have a high interest rate period that we've had undersupply. So it's very clear that it's not a single factor. The interest rates are not the single factor holding back housing supply. I mentioned some of the factors. It's a very complex issue, a lot of variety of issues affecting housing supply in Canada. Some of those are related to a slow process for municipal approvals. There are and some of it's related to shortage of construction workers. But there's a variety of issues out there, and it's a very complex issue. And we are happy to see that all levels of government are paying attention to that, and hopefully they'll continue providing more changes in their policies to increase the housing supply, or alleviate the housing supply issue that I mentioned in the speech.
Chris Campbell with CTV Windsor. I'm just hoping you can provide some advice to Windsor-Essex residents in a community where food bank use has doubled over the last year and homelessness continues to grow. Some advice between now and January 24th for affording the holidays, knowing that we're in the midst of the holiday season.
I mean, we at the Bank of Canada are very cognizant that people have been facing a lot more hardship related to increases in prices of all kinds of things, in particular food. In that respect, food inflation is too high. It's coming down, but it still remains too high. I mean, we have been, our goal is to bring inflation down more generally, including food inflation. And in doing so, we've had to, we have one instrument, it's our policy rate. And in using that policy instrument, we're aiming to slow the economy down so that all kinds of inflation, including food inflation, continues to come down and allows more people to live within their means. Inflation hurts everybody in Canada, and that's why we're working hard to bring inflation back down to 2%.
Thank you. We'll now be going to journalists on the call. So I'd just like to remind people to mute their line if they're not asking a question. So we will be starting with Paul Vieira of the Wall Street Journal, then going on to Eric of Bloomberg, and then Max Sato of Mace News. So you can go ahead, Paul.
Mr. Gravelle, in the speech you said that we need to see further progress on inflation, and you tried to play down October data as just 1 month of figures. Can you quantify what you and the bank mean by further progress? Does inflation have to be at or near 2% for a certain number of months before rate cuts can be entertained?
I think I mentioned it in the speech. What we're really focused on is underlying inflation, core inflation in particular, and we're looking to see how that and other measures of inflation are on a sustainable path to 2%. Doesn't mean they have to be right at 2%. So one of the things to get more comfort that we're on a sustainable path is we're looking at these other indicators as well as that I mentioned in the speech. We're looking at wage growth. We're looking at firm pricing behavior. We're looking at inflation expectations. These and what we're seeing in the data will be informative in terms of us understanding if we're on a sustainable path to 2%. That we're not there yet. What we've said is that we saw 1 month of good data, and 1 month doesn't make a trend. Given the other factors, the other indicators we're looking at, it's still pretty clear that we're not on a sustainable path to 2% yet. But we see the economy slowing. We're starting to see some good news in that respect. We assess that we no longer see any excess demand, and that should be reducing inflationary pressures going forward.
Thank you. We'll now go to Eric Hertzberg of Bloomberg.
Hey, good afternoon, Deputy Governor. In October, the summary of Governing Council's deliberations noted that some members felt that it was more likely than not that the policy rate would need to increase further to return inflation to target. Were you one of those members? And were some of the members of Governing Council expressing similar expectations that rates would likely need to move higher during the December deliberations for this meeting?
Well, I mean, summer deliberations used to increase transparency to Canadians. So we wanted to give a bit more insight, be very forthright in what are the issues we're tackling and what are the discussions we're having and what are the views that are being brought to the table. So we wanted to be a bit more transparent with Canadians. It also wanted to be very forthright in terms of the variety of views that we bring to the table. In a sense that we thoroughly hash out all the issues hitting the economy. We thoroughly hash out all the perspectives that might be useful in terms of understanding what's happening to the economy. So in a sense, we want to bring that diversity in. We and one of the ways to bring that diversity in, we actually have now a non-executive deputy governor. So we really think that diversity of views is really important. In the October decision, we came to a consensus view that we needed to hold the policy rate at 5%. We did discuss forward-looking scenarios where some of my colleagues had different weights on these forward-looking scenarios across all of us, and that meant that some of the scenarios played a bigger role in their views versus other types of scenarios. So that's what you're referring to, is basically us being transparent about what we're looking forward to in terms of what potential scenarios might play out. And again, what you'll see in the next summer deliberation that comes out on December 20th is, again, you're going to see a reflection of different views. But at the end of the day, we decide on the current policy decision. In this case, it was Wednesday's policy decision. And we came to a consensus to hold the policy rate at 5%, as I mentioned in the speech.
Thank you. We'll now go to Max Sato of Mace News.
Thank you, Deputy Governor. Judging from your speech today and the official statement, you seem to be more concerned about the upside risk to inflation because of sticky services and housing costs especially. But when you talk about the risk of over-tightening, do you actually see a possibility of that's going to hurt the economic growth rate, but inflation may not come down all the way to 2%?
If I understood your question correctly, I think you're asking about the risk of excessive slowdown. So, I mean, we've been pretty clear in our communication that we are worried about the over-tightening as well as under-tightening. We don't want the economy to slow down too much unnecessarily. However, we also don't want Canadians, as I mentioned earlier in the previous questions, to live with high inflation, especially inflation in certain categories like food inflation. So in that sense, I mean, we always keep that in mind when we have deliberations. I think your other part of the question was related to that we mentioned in our press release that we still see risk to the inflation outlook and are prepared to raise our policy rate further. That is basically a reference to what we've been concerned about for a long time, this potential persistence in the inflation profile. That persistence is reflected in some of the indicators we're looking at. We still see continued high wage growth of between 4% and 5%. We still see high inflation expectations, short-term inflation expectations. And we haven't seen price-setting behavior of firms come back to normal yet. Those are starting to move towards that direction, but we haven't seen enough data for us to be less concerned about the inflation risk, the inflation outlook that could continue. It could have a period of increases that we've seen. I'll remind you also that in the summer we saw inflation go down to 2.8% in June, and then it popped back up to 4% in August. So there's still some volatility out there, and that's why we're still holding on to our sort of our view that there are still some risks to the inflation outlook. And finally, I'll refer back to a previous question, is that although we've seen some good news in certain inflation measures in October, it's only one data point. We want to see enough information, enough evidence that we see the inflation on a sustainable path to 2%.
Thank you. We'll now go to Greg Quinn of Market News, after which we'll go to Steve Shearer, and after we'll go to Najoud from CP. So Greg, you can go ahead.
Good afternoon. I wanted to ask about forward guidance. Through the pandemic, central banks in Canada and across a lot of the developed world said that forward guidance was a bit of a helpful additional tool to underline where things were going, and it even helped maybe curb inflation when it was peaking by nudging yields in financial markets. But over most of this year, investors have been consistently betting on big interest rate cuts, even as officials in many countries have talked about more hikes. Is this divergence significant for for bank policy now?
Okay, there's a couple of issues embedded in your question. So forward guidance, it comes in two forms. There's the form that most people know of that we used during the COVID crisis, where we committed to holding our policy rate at the effective lower bound, at the lowest level. And that's what I'll call extraordinary forward guidance. And then there's another type of forward guidance where central banks provide a hint about the next decision, largely. I mean, the U.S., the Federal Reserve Board tends to do that, where they provide views that they provide a set of views that kind of hints at the next decision. That's kind of a more milder form of forward guidance. I think in terms of divergence point you were trying to raise, I think what we try to do in terms of trying to be transparent and try to have forward guidance, well, more transparency in general, maybe not so much forward guidance, is that more transparency allows the market participants to understand how we react to incoming data. The better they understand how we react to incoming data, the better that they sort of price in the typical way we react to income data, and they're able to anticipate better what we're going to do, either in the next meeting or in a set of future meetings. So that's why we've introduced the summary deliberation as one of the reasons. We want the market participants to have an even better sense of what we're how we're thinking about certain data. But there still will be divergence. I mean, we take one decision at a time. When we get to a decision date, we take in all the data that we've had. We take in the staff projections of various forecasts for the economy. And then as the data shifts, those things might move around. And markets will do that too to some degree, but there will always be a certain divergence in terms of where they price in our future decisions. It's not perfect. So I don't think I will put a lot of weight in the degree of divergence. Where the biggest concern when there's divergence between the market and ourselves is actually the next decision, the very next decision. And currently, the market's been relatively right on our previous 2 or 3 decisions. So it seems like they're taking in the data in the same way we are.
Thank you. We'll now go to Steve Shearer of Reuters. Steve, you can go ahead.
Thank you. Hi, Deputy Governor. I wanted to ask, Canadian bond yields have fallen about 100 basis points since October. How does that impact the Bank of Canada's efforts to tame inflation?
So we take all financial conditions into consideration when we make our decisions. Financial considerations are taken as given. We input it into our perspectives, and when we have a projection, a model, we also input that into the projection. In principle and conceptually, loosening of financial conditions usually helps improve economic growth, or puts upward pressure on economic growth. But there's a lot of that's a very nuanced process. It really depends on what is driving those changes in economic conditions. Sometimes economic conditions, for example, loosen because markets anticipate the central bank to be cutting, or sometimes they loosen because they see some change in risks out there, like a change in term premium, for example. So our reaction and how we take that into account in our forecast will depend a bit on that. But our decisions also depend on a whole slew of other parameters, other factors, other macroeconomic data. And so I just want to emphasize that financial conditions is one factor in terms of affecting our decision.
Thank you. We'll go to Najoud Al-Maliz of CP.
Hi, I'm wondering what your message is to financial markets and also Canadians who are now speculating on when rate cuts might start coming to fruition.
Again, I'm just going to go back to what we're looking for in terms of in terms of the inflation dynamics. We've seen one some relatively good news in terms of both the economy slowing. We believe that the economy is no longer in excess demand, which had been putting upward pressure on inflation. We saw some relatively good news in terms of inflation coming down in October. But I want to be clear that what we're looking at in terms of our decision making is underlying inflation, and and we're looking for a trend, a sustainable trend in underlying inflation going to 2%. Some of the indicators we're using to assess that have been listed several times. Aside from excess demand, we're looking at wage price increases. We're looking at inflation expectations. We're looking at how firms have changed their price setting behavior. And once we get more confidence that we have seen that inflation is on a sustainable path to 2%, which includes some of those indicators, but also we look at a variety of other issues, then we might be in a position to even start thinking about cutting rates, but we're not even there.
Thank you. We'll go to our last question, which is Mark Brendel of the Globe and Mail.
Thank you for taking the question. Much of the speech talked about the need to boost home construction to deal with inflationary pressures. At the same time, high interest rates, disincentivize home construction. And I'm wondering how you reconcile these two things and whether monetary policy has a role to play in boosting home construction in Canada.
This goes back to a previous question to some degree, is that we've seen a lack, undersupply of homes when we've had low interest rates. We have an undersupply of homes now when we have high interest rates. So it's very clear that interest rates are not the only factor affecting the undersupply of homes. There's a variety of factors that affect the undersupply of homes. Some of those are policy associated, either at the municipal, provincial government level. Some of those are related to incentives for construction workers or new construction workers to join the industry. It's a very complex issue. For sure, typically, when we raise interest rates, we want to slow down the economy, and various sectors of the economy tend to slow down when interest rates go up. Higher interest rates tend to decrease demand for housing in normal times. But what we've seen is that we had low interest rates and a lack of supply of housing in low interest rates, and now we have a lack of supply in housing in higher interest rates. So it's very clear that there's other things happening than just interest rates in terms of providing more supply to housing.
Thank you, and this concludes the press conference. Thank you very much. Merci beaucoup.